some of the basics of building a portfolio and managing that portfolio for the objectives of making your money grow or making the money generate money, which is to generate income. Our concern is to let our money grow as fast and as safely as possible. Some people want the money to grow fast, like 10 or 15%. That can be done as long as you are willing to wait long term, like 5 years, 10 years. It's very difficult to predict what a stock market will do in any 1 month or any 1 year. And then if you, on the other hand, want your money to grow as safely as possible, then there are a number of ways to make your money grow between 2% and 6% a year. Not too much fluctuation, but not more than 6%. Fortunately, not less than 2%. So that would be, I will explain how you can invest money in government bonds as well as preferred shares. Later on, common shares will be explained, and how to build a portfolio of common shares for long-term growth. I'd like to recommend that you take a picture of this outline. I will be going over what is portfolio management. I will explain the objectives of portfolio management, which could either be income or growth or both. Meaning, do you want your 100 pesos to generate 5 pesos a year, or do you want the 100 pesos to double over 3, 4, or 5 years, which requires a different approach. I will explain why it's necessary to invest money. You cannot just keep it in the bank earning 0.5% a year, especially if the cost of living is going up 2% a year. And if your desire to spend money is growing up more than 10% a year. I need you to look at your savings and your income. Some of your savings will go into investment, and some of your future income will also be invested to take care of your requirements about 30 years from now. This is really for your own benefit, because you want to take care of yourself when you turn 60, 70, 80, and make sure you want to still have living expenses. You can't run out of money at the age of 80 or 90. You can't depend on others. You have to be able to generate your own savings. And then I'll explain how fast money can grow, because some money can only grow 2% a year, some 5% a year. Some can easily grow 12% a year if you know what you're doing, if you know how to go about it. And so I'll explain how that works, and then how to build a portfolio, which means, do I start with 3 stocks or 5 stocks or 10 stocks? Do I make half and half bonds and stocks? We go into that. I will essentially, when it comes to talking about ingredients, I really will follow the sectors of the economy. I'll talk about industry, services, sectors of the economy which are basic needs, and explain how as the economy grows 7% a year, your money should grow at least 7% a year. It would be a shame if it grew less than 7. The economy is growing. I want to be able to feel it, and I want to be able to actually let my money grow faster than my basic needs. Okay, and then towards the end, there's a review of the concepts and then an open forum. Now, let's go now to the first slide, which is what portfolio management is all about. It's all about choosing the right ingredients for you to be able to cook and generate, shall we say, a collection of shares of stock and or other securities which will give you desired results. And you may want to achieve health and wealth. The objectives of portfolio management are to be able to choose the right investments, assemble it in the right way, so that your money grows a certain % per year. I used this example in this slide of money growing 9 to 12% a year. That can be done if you choose the right instruments and you wait the requisite number of years, because it sometimes takes years for the average to come out as between 9 to 12% a year. Some years are less than 9, some years are more than 12, and then you'll get an average between 9 and 12. But this is just for example, because if your objective is to make your money grow something like 5 or 6% a year, that can be also achieved using the right instruments. And then the results that you're targeting are that you will eventually have money for retirement, which means that for the age of 60 to 90, maybe 100, you'll still have pocket money, living expenses. And then also you will have money for legacy. You may want to, shall we say, support the dreams and aspirations of your grandchildren and donate money for the good of your family for the next generations, like set aside, for example, 100,000 pesos that will be for the good of your family for the next 50 years, and that can be done. It's better than just spending all of your money and leaving nothing for the relatives and or the grandchildren or great-great-grandchildren. So that can be done with the help of legacy investments. Now, I go now to the basic imperative of investing money. The reason why we want to invest money and why we want to think about portfolio management is that we have a problem called inflation, and it needs to be counteracted. It means that the price of goods keeps going up over time because of pressures in the economy, and so therefore you eventually will come to the conclusion your money should also grow to fight inflation. If, for example, inflation is growing 2% and your money is growing 1, then I think your money is growing -1. If your money is growing 1 and inflation is 3, then your money is actually, in real terms, -2. Let's look at this example of cost of living going up, whereby something that used to cost you 100 pesos, maybe it's a cafeteria lunch, so is now costs 103 and then 106, and maybe even 300 pesos or 600 for ordinary working day lunch. That means that, I mean, that doesn't have to be food. It could be clothing and other items that we buy day to day. So if the prices of goods go up, then it means that the money that you had last year, which was 100 pesos, seems to be worth only 97 today. Because in order to buy the same item as last year, you'll have to add 3 pesos. So your 100 peso bill seems like it's worth only 97 because you have to add 3 to be able to buy the same item as today. Next year it will be worse because the 100 peso bill will be worth something like 94 only. See, so what it looks like to me is that if you have a 100 peso bill, you can cross out the number 100 and write 97 with a pentel pen, and that would be more accurate because that would be the purchasing power of that 100 peso bill after a year. And then the following year you cross out the 97 and you write 94 because your 100 peso bill is now worth only 94. See, so as the cost of living goes up, you have to do something to fight inflation. The cost of goods keeps getting bigger, and your defense against it is to invest your money wisely. Because of inflation, money tends to shrink. So just keep your money in the bank, say earning 1% or 0.5%, and with inflation at 2% now, I mean, worst case, it might get to 3 or so, then your 100 peso bill keeps on shrinking to 97 and 94. So imagine this peso bill getting smaller and smaller until one of these days we start using 500 peso coins. There are already such coins and they're just waiting for the right time to mass produce them. What happens to our money? Well, it becomes amusing but not really serious if we lose. All right then. Here's an example of if you want to learn more about stock investing and about seminars, there's a page on the website of First Metrosec that tells you there's a calendar of classes to attend to learn more about fundamentals and technicals and how to invest money in portfolios. Let's go on to number 4. The fourth topic is how to look at your savings and income so as to make sure you have money for the next 4 phases of your life. The first phase of your life is you need money for household needs. So that's normally kept in cash deposits. Number 2, there's some money that you need after some years. If you need the money after 5 years or 10 years, it would be suitable to keep such money in bonds because bonds give you the money back after 5 years or 10 years totally intact and with some income to boot. And then number 3, you need to have money for in case of any emergency. I would recommend cash, but cash equivalent to say 1 year's salary, and also set aside money in case of fire, in case of medical emergency. You never know when it might strike. Buy also insurance, and keep money on hand in case of emergency. So it's really difficult to do this because the instinct of every fun-loving person is to spend money as fast as you can earn it. And against this trend, I'd like to recommend that you be prudent and wise and responsible and save money in case of emergency. You're not going to need it, but you should not at all spend it. So you can either keep it in cash, bonds, or stocks. I recommend stocks, but that's just because I'm familiar with it. Now, the fourth item here on the lower left corner is money for retirement and legacy. So that's what you save money for your retirement. If you're a 30-year-old person, then you retire in about 30 years, at the age of 60. So how long is your investment horizon? You'll be investing for 30 years. What about legacy? You start saving a little money now, and then you figure that it'll keep growing and growing for the next 30 and 40 years. And it could be your gift to your future great-grandchildren. So I want you to look at your income this year plus your savings today. Of course, some of it has to take care of your expenses this year. But then you do have the discipline to set aside a certain amount to be your savings or investments. Well, let's just say that you invest your savings so that you try to make it grow somewhere between 5 and 12%. Now, when you do receive future income, I suggest that you keep on investing. Don't just be content with the initial savings, but keep on adding to it, because your needs in the future will be greater than your needs today. So this is just like saving money for a rainy day, right? So as you keep on investing, that is going to provide money for your future needs, either your future needs or your family's needs or your extended family. You never know when there might be an emergency or when there might be a serious need. Sometimes it's a happy need, like the family wants to go together to travel and to be together. So that would be a very happy bonding experience. It just costs money, and it was not foreseen, right? So provide money for future needs: retirement, legacy, travel, starting your own business, building a dream house, and then you will try to invest it wisely so that it grows to the right amount. Now, we're on to number 5. How fast should money grow? Well, there's two kinds of money: the money that you need over the next few years, and if you need it to be available for sure over the next few years, then you can't put it in stocks. You'll have to put it in something like bonds, because you need the money to be available when you need it. So it can't be growing negative. Then it must be in bonds, which tend to give you between 3 and 5% a year. Okay, so that's if you need to make the money grow even slowly, as long as it's for sure that it's secure. This is especially true if you're in charge of a big amount of money in stewardship for someone else or for some association or for a family institution. It's not your money. It might be a big amount of money and you're supposed to keep it intact. Okay, then it's not your money. So you just keep it safe. What about if you are investing for future needs? Then you're not restrained to stick to the 3 to 5%. You can go higher. You can go 6 to 16%. It just requires a lot of patience and responsibility and research. I'll explain. So just divide your money into 2 parts. The one that you need to be absolutely available after a few years, you have to keep it safe. But if you want faster growth, you must go into risky assets. And there's just it's like driving fast cars. You have to drive it in a special way, and you need training, right? So here's the drawing again of how do I allocate my savings and my future income. For survival, you need cash for household needs. And then for medium-term savings, for example, tuition and house, you need to keep it in safe and secure investments like bonds or money market mutual funds, for example. And then only when you are thinking to invest for long-term, then you can go to town with interesting risky assets, as long as you do research, diversify, and wait long-term. What's the benefit of being in cash? Well, it's constantly available, but it only grows 1% a year. 1% a year. Some of the cash is insured, so there's a benefit there. What about bonds? They're more secure even than cash because they're a loan to the national government. And bonds can give you 5% a year for 5 years, maybe 10 years, maybe 15 years. Now, stocks are risky, but they do have the ability to give you 15% a year for as long as 25 years, as long as you just play your cards right and you're not constantly shifting in and out if you're not so sure how it goes. So cash is not really for savings. Cash is for spending. Bonds is for saving, and stocks is also for saving and investing. right? So now you have the division of labor. What's the job of cash? To take care of my household needs. Why should I put money in bonds if I need to keep it safe and secure for the next 5 to 10 years? What about money I need to grow? Well, I can put it in either business, land titles, or shares of stock. If you're already running a family business and you're making millions every year, probably you're okay there already. But if you so wish, then you can still put, shall we say, savings or idle cash into shares of stock. But if your family business is already making lots of money, then you might be better served by just concentrating on that. I have a friend who makes money in his family business, puts it in stock, he neglects the stocks, and the value goes down. So I started to tell him, don't buy stocks anymore because it's not good for your health. Stick to your family business. I also have a friend who's very good in real estate. He keeps on making money in real estate, and he keeps on losing money in stocks. So I told him, stop already. I mean, you're okay with your real estate. You don't need stocks. But for people who may not have the enormous capital needed to run a business or to buy real estate, it's very good and advisable to buy shares of stock because you can get into stocks for a few hundred pesos, a few thousand pesos. You don't really need millions. Right, so now we're on number 6. How fast can money grow? As the Philippine economy grows 6 to 8%, I sincerely recommend that you target your long-term investments to grow more than 7%. It's very doable. The safe deposits are so-called savings accounts and then the time deposit, which some banks give you up to 1.6. Now, the secure and slow investments, there's the Treasury bill, and then the Republic of the Philippines dollar bond that pays 2% a year. There's the peso bonds that pay 3 to 5%, ranging from 5-year bonds to 15 to 25-year bonds. Then there's corporate bonds that it's just a corporation that borrows money from the public, and then they say, dear citizen, we'd like to borrow from you, and we'd like to pay you 5 to 6% a year. And now that is a very good proposition. If a corporation tells you that we'd like to borrow your money and we'll pay you 5 to 6% a year, go for it. Sometimes there's a very thick prospectus that you find it very intimidating to read, but all you need to look for is that sentence where it says, and we promise to pay you 5.5% a year. And maybe there's tax on it, but it will just reduce it by a tiny amount. So you still get 5.2. Now 5.2 is better than 0.5. So therefore, if you encounter a nice corporate bond, then go for it. Then there's preferred shares that tend to pay ranging from 6 to 7%. The origin of preferred shares is that some people are the friend of the owner of a corporation. So let's say that there's a corporation, it's listed, and then the business owner says, I need more money, I need 50 million more. So he turns to a friend and says, my friend, can I borrow 50 million? And the friend says, sure, here's the 50, what will you pay me? And then the business owner says, I'll pay you 6.5% a year. Sounds good. Okay, so the friend says, okay, keep the 50 million for as long as you need it, just pay me 6 to 7% a year. It's a good deal for him. Anyway, you're my friend, I lend the money to you, I know I can get it back if I really need it, so therefore preferred shares are okay. Now, the moment you buy common shares, these are the shares that are frequently traded with the public. And people buy and sell them every day, sometimes for the right reasons and sometimes for the wrong reasons. The reason why good stocks go up is because intelligent people buy them and then they go up in price. But sometimes there are good stocks which go down because not so intelligent people sell them believing certain negative rumors, so the stock goes down. Sayang naman. Sometimes the stock is bad, but it still goes up because certain people are listening to rumors and then they're not acting smartly and they buy it like crazy. So this is the area where people do what they like. It's a free market. So when you swim in that water, it's like swimming in a very turbulent water. But I still think that to invest in stocks over years is very fruitful. For example, I think that to invest in the top 30 stocks since 1987 would have given you 8% a year. To invest in the top 30 stocks since 2002 would have given you 14% a year. To invest in the top 30 stocks since 2009 would have given you 15% a year. So I can practically promise you that you would get 8 to 15% if you do invest long term, because the 8% is like the record since 1987 on the top 30 stocks. Just calculate index today divided by index 1987 and then see the growth per year. It comes out to about 8%. And then if you look at the index, the top 30 from 2009 to the present, it's something like 14.x% per year. So it's really good money that you make, even though you have no control over the ups and downs of those stocks during the year. So you really have to grit your teeth and wait for the 5-10 years that you promised. Anyway, you're 30 years old now. You're investing for the time that you turn 60. You do have 30 years of investment horizon. Don't be afraid to invest for 30 years because you'll get better results that way. When you only have a year to invest money, you can't really invest that money. Not unless you're trading. If you only have a year, you'll have to probably keep it in time deposit because you want to keep it safe and secure. Otherwise, it might go negative. If you only have 5 years, you'll have to keep it in bonds. But the moment you have 20 years to 30 years, then you can target 20% a year because you are waiting for 20 years time, and opportunities tend to pop up over time which were undreamt of. This thing about trading shares is for experts only. Beginners cannot expect to be expert in trading shares immediately. It's like learning a new sport. Let's say that you learn a new sport this year and you join a tournament. You can't expect to win the tournament in the first year, not even in the third year. Maybe in the 5th year, you get good at the sport and then you can win tournaments, but not in the first 5 years. So you really have to train yourself, learn this new skill, and then little by little get better at trading stocks. Anyway, the economy is helping you out. It's not like the 1980s where there was zero economic growth. It's not like the 1990s where the average economic growth was 2% per year. And we're way better than the 2000s to 2010, which was 4% economic growth. I want you to look at the rate of growth of these shares of the economy. 1990s, 2%. The year 2000s, average of 4% a year. And then by the year 2010s, 6%. You know, around 2010 or 11, that's when the economy managed to record 7% growth. And the previous time that it recorded 7% growth was back in 1977. So now we're happily at 7% growth, and we're looking fondly at the target of 8% growth in the 2020s. I think this is like a car accelerating from first gear to second gear to third gear to fourth gear, and then we still have a 5th gear coming up and a 6th gear. What parts of the economy are going to grow? I think target first basic needs: food, clothing, and shelter, energy, transport, and telecom. So if you're going to buy shares of stock or put up a business along these lines, they will meet plenty of demand because we have 110 million Filipinos. They all need food, clothing, shelter, energy, transport, telecom. They need schools, office buildings, houses. They need banks. They need minerals, metals. So the tremendous demand is going to keep fueling that economic growth. So therefore, how to build a portfolio? I totally recommend the economic approach. Think about what the country needs. It needs telecoms, energy, property, just for instance. And if you think a little more, the country also needs energy, minerals, banking services, food, computers. So there's lots of stocks that belong in your portfolio. And how I wish that you could attend the classes that I conduct every 2 weeks or so in our office in First Metro Securities, as well as in various places. I just conduct classes on how to build your first portfolio. But here goes a taste of it. Here's an example of a beginner's portfolio. Like for example, you want to invest your first 12,000 pesos in shares of stock. Then let's go look for a total portfolio that gives you cash dividends. Like for example, an energy stock like Meralco, put 2,000 pesos there approximately. Choose a telephone company such as PLDT or Globe, and then choose a food company. Could be, for example, Jollibee Foods. It's about 200 pesos nowadays, so this is going to be something like 12 or 13,000. Okay, you can do this again and again every other month or every month for that matter. Just look at the number of shares for the board lot. If share price is above 1,000 pesos per share, then you'll need to buy 5 shares minimum, multiples of 5. If the stock price is somewhere between 50 to 1,000 pesos per share, you'll need to buy in multiples of 10. Could be 10, 20, or 30. Could be 1,000 as long as it's a multiple of 10, and so on. If the price is 50 to between 5 and 50, then you'll need to buy in bunches of 100 shares. Okay, so just look at the example here. 200 peso stock times 10 shares equals 2,100. Now let's look at combination letter B. Let's say that you want more, like 7 or 8 stocks. Okay, then just buy 1 energy, 1 food, 1 property, 1 bank, 1 mining. I would recommend Semirara, or wait for Apex Mining to do a recovery. Then transport, something like Cebu Pacific. Then construction, DM Consunhi or Megawide, and telecom, either Globe or PLDT. So that would give you a roughly 30,000 peso portfolio. And again, remember the board lots, right? So just take a picture. If you want, build your own portfolio. This would be your first 7 or 8 stocks. And then every month that, or every time you have another 30,000 to invest, put it in the same stocks again, the same again. Just make your money, divide your money among the stocks. Decide on the minimum number of shares just to be able to make it all fit in 30,000. All right, so let's look at number 3. Number 3 combination is to buy 30 blue chip companies using 1 transaction. And you can do this with the FM Exchange Traded Fund, nicknamed FM ETF. This fund started in December of 2013 at the number 100. And I think it's now at 127. So therefore, it went up 27% in the last 3 years or so. And for as long as the FM ETF copies the top 30 companies of the index, then anytime the top 30 companies go up 1%, the FM ETF also goes up 1%. Well, this also means that as if the top 30 go down 2%, then the FM ETF also goes down 2%. It just copies the movement of the index. This is a very efficient way of buying the top 30 because in just one transaction of approximately 1,270 pesos, then you have under your belt, so to speak, the top 30 listed companies. You have an investment in a basket of securities that represents the movement of the entire index. So that's very advisable because it's instant diversification. You don't only buy 1 stock, you're practically buying 30. Next, for family learning, I suggest that you hold a family meeting with all your relatives, uncles, aunties, lolo, and lola, and then recommend that one of your relatives monitors this portfolio, meaning one of your relatives designs and perhaps manages and monitors a portfolio that's invested in conglomerates. So his job would be to look at the conglomerates and say, we should put some money in this stock, some money in the second, some in the third. You decide on the percentage. It just has to add up to 100. It's completely up to you how much money you put into each one. For example, if you're going to put 20% of the money in the first company, then divide the 20,000 pesos by the share price, and you're going to get the minimum number of shares. Then you just simply round it off by the board lot. Number 2, right? Okay, so number 1 is conglomerates, and this is your family learning portfolio where some member of your family monitors this portfolio and talks to the rest of the family every month or every weekend. How is it going? Number two, assign another member of your family to study consumer trends. It's like permanent homework. Every Sunday, tell us what's happening with Jollibee, what's happening with Pure Gold, Universal Robina, Robinson's Retail. Is it going up? Is it going down, sideways? Are prospects good? So as long as you invest, say, 100,000 pesos in these stocks, then you just have to divide it into how many percent for each one. That's your assignment. You pick and choose the stocks that you like the most, and you put the majority of the percentage there, followed by 20%, 15%, and then down to 10%, maybe down to 5%. That's your decision. That's your allocation. And then you'll have to just live with the consequences. No one can really guide you here, because if a broker tells you what to do and it turns out right, then good for him. But if it turns out not so nice, then you might blame the broker. So clients nowadays really have to decide for themselves how to allocate the money into, and then tell the broker and or tell the online trading system what to buy. So this is consumer trends. Now let's look at number 3, property and real estate. You decide which of these listed companies you're going to put money in. You decide how much money in each one. You decide whether you're going to buy all of them or half of them or just one of them. I just think that you need to have some money in property and real estate. If you wish, you can put 100,000 pesos in just one of these companies on the list, or 50,000 in one and 50,000 in the other. It could be 60-40. That's your homework for this weekend, for this Holy Week. And then there's infrastructure that needs to be invested in, because companies are going big time into infrastructure and you need to be able to benefit from it. Maybe you have a member of your family who's good in engineering, architecture, or construction, and then he can be the advisor as to sino talaga ang pinakamagaling na infrastructure company. So then you can have an insider's point of view on which is the most progressive and most profitable company in this line of business. Number 5 is you ought to have money invested in energy and electricity, because the country needs enormous amounts of electricity. And the more the country progresses, the more energy it needs. So it's up to you to, if you're investing 100,000 pesos, for example, in energy and electricity, to decide how much of it will be put in Meralco, how much in Avoitis Power, FGen Hydroelectric, EDC Geothermal, and Semirara Mining and Coal. So you decide, somebody in your family has to do the homework and report to the body. I think that I should put 20% in this company, 30% in that other, and defend your reasons and submit to cross-examination. Number 6, the country also needs transport and telecom. So you probably should have companies in transport and telecom in your portfolio. Again, you can choose only one of them, or just 2, or just 3. I recommend get all of them, but just work on the percentages. Work on how much percent to be placed in each one, and then you monitor over time. And then somebody should be specializing in what's the business news pertaining to telecom. Is it positive? Is it negative? Are they having gonna have a great year, or will they be facing tremendous competition from various other competitors, and are they gonna have less revenues this year? Are they going to have less revenues this year but fantastic earnings next year? So somebody has to keep track of the business news and attend the stockholders meetings. You know, when you buy even just a few thousand pesos worth of shares of stock, you get invited to the stockholders meetings, which are a very nice event where you get invited to a very nice meal in a first-class hotel or restaurant, and then you are treated to a presentation on the news about the company plus the outlook, and then you can even pick up the microphone and ask questions to the chairman. So I want you to go through this experience. You'll be invited the moment you become a stockholder, And then you'll learn more about the company firsthand from the horse's mouth. What's after number 6? Transport, telecom, banking. Because business grows and business needs loans to put up more factories, to expand their businesses. And there's also consumers who want to borrow money for cars, motorcycles, housing loans, credit cards. So, so there's all kinds of business loans that are coming up, and also consumer loans. So all of that's profitable for the banks. They get to lend, they get to collect, they get to earn millions and billions, and that's their hard work. They have to lend money and lend it to the most capable borrowers. You just decide if you're going to put 100,000 pesos in banks, then you spread it out over the top 4, 5 banks, and then check if the others are also on the way up or still moving sideways or on the way down. So you have appoint one member of your family to research on the banking sector and to ask around, should I put majority in bank number 1 and then minority of the money in bank number 2? So do a study, compare and contrast. It's your homework, it's your thesis, and invest 100,000 wisely and keep updating that research over time. Now, number 8, there's mining and minerals. So yeah, they're important for the development of industry and the economy. For the meantime, I would recommend 90% in semi-rara coal. This is just a personal opinion. You are free to disagree, and maybe spread out 2% in the other companies in case they improve suddenly. Then you start putting more in them. This is only a suggestion, and this is in no way represents the opinion of First Metro Securities. So you'll have to speak with the head of research and analyst there to figure out what they recommend for the next few months for the year. This is basic process of building a portfolio, and I just showed you an example of how I decided that semi-rara should get 90% of my portfolio in mining and minerals. But you're free to disagree and have a different percentage. It's your homework to read up on all of these companies and what their prospects are. Check with the heads of research, with the research analysts of every broker house, what are the fundamentals and technicals of these companies, and are they poised to move up already, or are they still moving sideways? Okay. Check the technicals too, because at various points in time, there might be tremendous good news for companies, even in beleaguered industries like mining. So this one is, for the next 9 months, is looking like it's going to be moving up bullishly up to the area of 160. And then there's also the other sectors that we have to look at. Let's see. The other sectors that we have to look at, which I've mentioned, there. So buy some, put some money in the top 30, that's the PSEI. Put some money in banks and financials. Put some money in industrials. These holding firms are the so-called conglomerates. They are good proxy for the economy in the sense that each firm seems to have 5 or 7 smaller businesses under it, and as long as they manage it expertly, then it will be a money-making machine. Then there's services like transportation and trade, and then there's mining and oil, and then property or real estate. So make sure that you have money in all sectors so that you're covered, because the economy is going up and it's hard to predict exactly which one will move the fastest. If you knew exactly which will move the fastest, for example, if you thought that industrial would be moving the fastest for the next 10 years, then you would be justified in putting all your money in industrial stocks if you knew for sure that it would be the fastest growing sector. But if you don't know which will be the fastest growing sector, is it going to be food, banking, or what, then might as well spread out your money among these various sectors, because you're not sure. And you want to be capturing all the growth of these sectors. Okay, so attend more classes on basics, and visit our company website at fmsec.com.ph, or email me for questions, or simply dial 859-0600 and ask, how do I open an account, or email customer service. Right, so we're into our last 5 minutes. Let's just review the concepts learned. Portfolio management is a matter of choosing the right ingredients that you will then cook and then arrange it into your collection of shares of stock until you get the results that you want, which would be health and wealth, financial health. And then number 2 would be your objectives are to choose the right investments to be able to assemble the parts of the puzzle so that your money grows 9 to 12% a year if that's your target. And then you will get the results of having emergency money, having retirement money, and legacy money. I mentioned that in order to build a portfolio, I mentioned that you'll have to beat inflation, counteract inflation by making sure your money grows more than inflation, more than 2% inflation, as high as, make it go higher than 2%, closer to 10. Then to build a portfolio, you need to practice with maybe 3 stocks this year, maybe 7 stocks next year. Maybe 3 years from now or a few years from now, you'll be having a more complex portfolio until you have very colorful structures with even second liner stocks. And I'm just talking about stocks here. There's more to investments than just stocks. There's cash, there's deposits, there's bonds, and there's more to stocks than just common stocks. There's preferred shares that give you 6 to 7%. Okay, so you choose the sector where you think you're, which will address your needs. You decide what your needs are. Are you more for growth? Then you have more of risky assets. Are you more for safety? Then you're more closer to time deposits. You want some income as well? Then you go for bonds and peso bonds and corporate bonds. Alrighty, so I think that that concludes the presentation. I endeavored to show you what portfolio management is all about, how you combine cash, stocks, and bonds into a portfolio, how you also decide to put certain types of stocks together so that you will achieve growth and income or both.
If you need to get in touch with us, the contact details of the PSE Market Education team are on our websites at www.pse.com.ph and www.pseacademy.com.ph. For more updates on PSE's market education activities, follow our official Facebook and Twitter accounts at PH Stock Exchange.